Oh, have you recovered from the sip from the fire hose? All the different types of mutual funds, and remembering that these are just the major categories. Well, guess what? It's going to get even worse now. Because now we'll finish our discussion of mutual funds by taking a look at the various fund families and then concentrating on a sample mutual fund and see what kind of returns we can get from these investment vehicles. Slide 16, a fund family. A fund family, a family of funds, exists when one mutual fund, one investment company manages a group of mutual funds. So it used to be, this was many years ago, that a mutual fund company had maybe one, maybe two mutual funds. And then some companies started adding more and more, and their competitors started adding more and more, until finally you had these huge mutual fund families with dozens, hundreds of different funds. And if one mutual fund created a domestic stock growth and income fund, large cap, whatever, then they all had to have it, right? So the funds in the family vary in their objectives. And you can move your money from one fund to another, almost always with no charge. They're not going to charge you another sales charge. But if it isn't a taxable transaction, you could end up generating a taxable transaction. If you made money, yeah, capital gains. If you lost money, well, then you have a capital loss. If it's in a retirement account, 401k, Roth IRA, then no, the IRS doesn't want to talk to you until you take the money out. Now, when I say almost always with no charge, there are some exceptions, and they mostly pertain to people who tend to use mutual funds as trading vehicles. They'll buy one mutual fund for a month and then sell it and buy another one. That's not what mutual funds were meant for. So what some companies will do is they'll say, all right, you want to do that? Fine, we're going to charge you 2%. In other words, they're trying to tell you not to do it. Some companies just won't let you do it, such as Vanguard and American funds. They just say, no, you can't do this. This is not what mutual funds are for. Others say, sure, you want to do it? We'll charge you 2%. So in other words, they're saying, don't do that, okay? Because mutual funds are long-term investments. So you're not going to, if you do it every 6 months, a year, okay, you're balancing things out or whatever. But don't do it every few weeks or every month. Here they are, slide 17. And again, this is data that came from the ICA.org through the investment news via a gentleman by the name of John Wagner, who's actually a very reputable writer, so I tend to believe it. I have a hard time coaxing the data out of the ICI.org website, so I let it up. What happened to Templeton? Mr. Templeton I have to fix that. Mr. Templeton got split in two here. But the big three are Vanguard, Fidelity, and American. And it depends on how you look at them. Sometimes American is put ahead of Fidelity, but by far the biggest one is Vanguard. Vanguard is the biggest mutual fund company out there. And all three of these are good groups. I'm a big fan of American myself, but excuse me, pardon. Fidelity has a very good, some not so great, and Vanguard has some very good funds also. But T. Rowe Price is another very good mutual fund company. It's been around for decades. In fact, you're going to look at one of the T. Rowe Price mutual funds in the assignment, and you also look at one of American's and Fidelity's also. J.P. Morgan Chase got to the big top by buying a bunch of other mutual fund companies and turning them into one company. And then BlackRock. Now, here's a real interesting company, folks. They haven't been around as long as many of the others, but they have just become the world's largest money manager. Now, their mutual funds, are not as large as some of the other mutual fund companies, but they also manage private money and money for countries. Yeah, they're a big group. And then Franklin Templeton. I'll have to fix that. I don't know what happened there, but the Templeton got separated. Franklin Templeton, another company that's been around for decades. Very good company. Has some great funds. A lot of good bond funds. and some great global funds. Remember Sir John Templeton? Yeah, that was his company that he eventually sold and retired. But they also have a series called Mutual Series, which is another very good company. It's in part of Franklin Templeton. Now, TIAA, I don't know if you remember back in life insurance, but they started out as a Teachers Insurance Annuity Association, only for educators. But now they've gone mainstream and they merged with Nuveen, and I don't know much about Nuveen at all. But they're a good group. And then Dimensional Funds. This, again, I'm not too familiar with them, but they're very popular with advisors. Very popular with advisors, so I should really do a little digging into them. PIMCO stands for Pacific Investment Company. They're based up in Newport Beach, if you can believe that. But again, they're a global company, and they had the biggest mutual fund in the world for many years, which was a bond fund. But then the famous manager who ran the fund left, and so PIMCO all of a sudden is now, what are they going to do? But they still have some very good funds. So, but I'm a bit, as I said, I'm partial to this company. But T. Rowe Price, Franklin Templeton, another company it's actually much smaller than the others, Dodge and Cox. Very good company. And 6 of these companies are in Canvas on the class website. So check them out, or check out the ones that are in your 401k, your 403b, or your IRA, whatever. Okay, now what do we do? In the face-to-face class, we would show some of Vanguards and Fidelities and Americans. And Fidelity's the real kicker, because you go to their website and they have over 500 different funds, right? But then they also sell everybody else's fund. So you click on the one click and it shows you about, anywhere from 300 to 500 of their funds. And then you click on the other one and it shows you over 11,000 funds that they can sell you. They're a very smart marketing organization, Fidelity. American, I like to show because they all fit on one page, and we can see the lifetime returns, and we see that the stock funds have returned, better than the bond funds, is what you'd expect, and of course the cash, the money market mutual funds have returned the least. But then we show 2008, and we see that 2008 was just horrible, with some of the funds losing 50%. And that was good in 2008 if you were an aggressive growth fund. That was actually pretty darn good, a growth fund or an aggressive growth fund. And then we see the growth and income fund losing about 35%. Then we see the equity income fund losing about 30%. The balance fund losing about 30%. The bond funds losing 15% and 10%. And so we see that during times of extreme volatility, which is a euphemism for, oh my God, I lost so much money, please, Lord. Yeah, wrong thing to pray for. But yes, and that's something that you're going to experience. If you've invested in stocks over the long term, there's going to be times when they're going to fall, but don't panic. Unless the world ends, and then it doesn't matter. I'll meet you at the beach. You bring the vodka. I'll bring the marshmallows. We'll have a good time. Slide number 18. Oh, by the way, I forgot to add. Oops. Because of the mutual fund scandals of 2003, there used to be about 2 or 3 companies that were kicked out of the top 10. Who are they? Janus, Alliance. Who was the other one? Putnam. Yeah, okay. Oh my goodness. Wait a minute. Did you say mutual fund scandals? You want me to invest in an industry that is plagued with scandal? Well, as a matter of fact, yes. Yeah. Since 1940, the mutual fund industry has been heavily regulated and escaped any hint of impropriety. You like that word, impropriety? It means hanky-panky. And in 2003, some practices that were not quite illegal, but obviously unethical, were uncovered. And only a handful of funds and people were affected. Strong funds, which are now gone. Janus, Bank of America, Putnam. Putnam is one of the oldest mutual funds, been around for decades. Alliance, a very good mutual fund company. And they were just destroyed because a few people, sometimes in the case of Alliance, there were 2 people who were doing this. Now, what were they doing? It's hard to explain, but they were stealing pennies, literally pennies, but not illegally. They weren't doing it illegally, which is why it was obviously unethical. And in the case of Mr. Strong, who started his own mutual fund company, was worth $600 million at the time he did this, were barred from life from ever working in the industry again. So it's not as though you lost $99,999 on a $100,000 account, which is what happened for the people who owned Enron stock. And if you don't know who Enron is, look it up. They were a company that used to be very boring, an energy company, but then became very exciting by way of fraud. And the people who owned their stock lost everything. You lost, and I say here on this slide, $1 on a $100,000 account. It really wasn't even $1. It might have been a couple of pennies. But when you have 1 million investors, that's a lot of money. And the gentleman who started Strong Funds, he at the time was worth about $600 million, and he made about $80,000 doing this. All right. I mean, to you and me, that's a lot of money, but to him it was pocket change. And afterwards he was very contrite. He apologized to the world and said, look, this was stupid. I started to believe everything I read about myself, that I was invincible, that I could do anything, and this is like a Greek tragedy. You folks over in the literature department could look up people who brought about their own downfall through hubris. Great word, isn't it? Hubris. The vast majority of companies never engaged in any of these shenanigans. They just didn't do it. But just a few people did. And it tarred the industry. So don't worry, it ain't going to happen again. At least this isn't. The way they did it before is not going to happen again. So slide number 19. Oh, boy. Especially if you were in the face-to-face class and saw that hundreds, thousands of mutual funds out there. You're obviously thinking to yourself, okay, well, how do I pick a mutual fund? It ain't easy. That's the hardest part about mutual funds. Once you've chosen the mutual fund, everything else is easy. There's not much else for you to do except make sure you keep funding it. But here's some advice from yours truly. Take it for what it's worth. Pick a mutual fund that invests in high-quality stocks or bonds. You want to concentrate on quality. Now, quality, if you've ever studied it, is a very difficult thing to define. Quality is in the eyes of the beholder. It's often associated with the word love. How do you define love? Good luck. Poets and philosophers have been trying to do that for hundreds of thousands of years. But you know quality when you see it. When you see the companies that they invest in, you go, oh yeah, that's a real company. They've been around for decades. They're going to be around for decades. Is well diversified across several industries and sectors of the economy. In fact, I like global mutual funds. Has a long-term perspective. And a manager, or better yet, the management team we talked about with many years of experience. You want to avoid companies that shuffle their managers every few years, which used to be virtually all of them. In fact, if you were somebody coming right out of Harvard or Stanford or the University of Pennsylvania Wharton School of Management, you would be a Wunderkid, your Wunderkind, or whatever the word is in German, a wonder child, and they would throw $1 billion at you and say, here you go, kid, have at it. So you're not stupid, right? You know that if you do well, within 18 months, 2 months, you get to keep your job, you get showered with love and attention and a whole lot of money. So you're not necessarily going to think in terms of the long term. You're going to shuffle or roll the dice or stack the aces or whatever. You're going to try to shoot for the fences, throw the Hail Mary pass, whatever analogy you want to use. But you're going to try to be very aggressive because you know that if you don't do well, you're going to get kicked out anyway. And if you do well, congratulations. Well, now the mutual fund companies have figured this out. They said, look, this is not the best way to invest for the long term. So more and more of them are switching to team managements where everybody works together, but they make their own decisions. And that's a good thing. And most importantly, you want a company that's been around for decades and performed consistently well in both good and bad markets. You see, don't tell me how well you've done in a good market, because I ain't interested. I'm not. I want to know how well you did when the organic matter hit the ventilating device, because it's going to happen. And that's the time, in my humble opinion, that these people earn their money, when the downside hits. They want to. There's an old saying that Warren Buffett likes to use: when the tide goes out, you can see who's been swimming naked. I don't know if that makes any sense, but think about it. Yes, in other words, there are going to be bad times, and you want them to be ready for those times. Cool. Okay, so what we do now, dear students, in the face-to-face class is concentrate on a sample stock mutual fund. And this one's been around for over 84 years. And it's now what we call, before, they didn't call it this because they didn't have these titles, but it's a domestic large cap growth and income stock fund, which means it invests mostly in companies in the United States, a few outside the United States, and invests in big companies that have their roots deep in the economy for growth, capital gains, and for income dividends. So on the website and, of course, in Canvas, there are a few links to various pieces about this mutual fund. It's only one mutual fund because we got to look at least one, right, out of 10, 11,000. But it's a very good one that's been around for a very long time, which is why we love this mutual fund. We love to use it as an example. Because remember we said 8, 9, 10% from stocks? These guys over 80 years have done 12%. Pretty darn good, yeah. And you'll hear people say, well, stocks are very risky, right? You're right. In the short term, yes. But it turns out if you just extend your time horizon, just think 5, 10, 15 or more years, stocks have been the place to be. Now's not a good time to invest. Well, look, even if you had invested at the worst day of the past 25 years, every day the market hit the high, right? As long as you held on and didn't panic, you did okay. Now, you didn't do as well if you had picked the best day, but remember, you're not going to pick the best day. You're not going to pick the worst day. You're going to be putting money in every month or so. And that's how you deal with the market downturns. You keep a long-term perspective and you dollar cost average. That bad phrase, I can't come up with, if you can come up with a better one, please tell me. But the dollar cost averaging on slide 21 is a system of buying an investment at regular intervals with a fixed dollar amount. You see, with dollar cost averaging, there is always good news. That's what I would tell my wife when we first got married. She was terrified of stocks, and I would say, look, Anita, because that's her name. I'd say, Anita, no matter what happens, tomorrow morning when we wake up, there's good news. Because the market's up. Good news, yippee! Your account is worth more. Your $100 is now $100.25. The market's down. Good news. Huh? What are you talking about? No, yes, indeed. Next month, you're going to get more shares at a lower price when the $50 or $100 comes out of your paycheck or checking account. Now, again, are you going to pick the high highs, the low lows? No, you're going to be putting money in every $50, $100 or more if you can afford it. Out of your paycheck, out of your checking account every month, you're going to be dollar cost averaging. Now, it's not a guarantee. If you pick a lousy investment, it's not going to make it work. But it's pretty darn close to the easiest method of investing that I've ever thought of, that I can think of. If you can think of a better one, please do. I mean, if you have $100,000 to invest, great, fabulous. But how many of us have $10,000 or $100,000 or whatever laying around the house? So, slide 22. Hypotheticals. Most mutual fund companies have a system for running what are called hypotheticals, hypothetical illustrations. That's what the insurance companies have, these too. They're examples of returns of investments for either a lump sum or a stream of investments, which is another term for dollar cost averaging. That's about the closest one I could come up with, stream of investments. But that's not the best. Or a combination of both lump sum and streams of investments. So they must be approved by the Securities Exchange Commission, Financial Industry Regulatory Authority, and contain disclaimers about past versus future performance. Now, we've already showed you these in chapters 11 and 12, and now they're in 13. We'll see them again in 14. So take a look at those in the face-to-face class. This is when we would take a look at those now. But take a look at those on your own and see that the news is good. If we have a long-term perspective and the world doesn't end, the news is good. So go check out those hypotheticals. If you'd like to see any others, contact me, because as I said, I can talk about this a whole lot longer than most anybody would really want to listen, but I'll run as many as you want because I love doing this stuff. Slide 23. And that's not the only one. I'm not trying to sell you ICA, an Investment Company of America. It's been around since 1934. Actually, it started back in the 20s, but then they changed managers, so they restart the clock. But look, do you remember this slide from chapter 1? Yeah, this is as of December 31st, 2017. We see there are a couple of dozen that have been around for 50 years or older. There's Dodge and Cox. There's a couple of American funds. There's Fidelity, Franklin. There's the Investment Company of America. MFS, this is the nation's oldest mutual fund company. Massachusetts Funds for Services. I forget what MFS stands for, but it's Massachusetts. And then there's T. Rowe Price, Dreyfus, Putnam. There's Templeton, again, Franklin. There's a Vanguard fund and another American fund. So folks, I'm not trying to sell you these mutual funds either. I mean, they're very good mutual funds. They tend to be mostly all domestic, except for the Templeton fund, because most people just didn't invest outside the United States over 50 years ago. They stayed inside the United States. But there are other mutual funds that have done better than these over the long term. I mean, look at this T. Rowe Price fund. Small companies, very volatile, but 13%. Well done. So, you see, the news is good. There are very good mutual funds out there that have been around for decades and have done well in good times and bad times. Cool? Cool. And so, slide 24, what's the bottom line on mutual funds? Choose a fund family, stick with them, because there's a saying, most mutual fund investors do worse than the mutual funds they invest in. Huh? How could that be so? I mean, how could you do worse than the things it's very easy. You wait until the market goes up 100, 200%, and you say, ooh, is it too late to get in? So you put your money in just to watch it drop 30%, and then you cry, is it too late to get out? And then you take your money out. Hopefully you have somebody who persuades you. I call it my talk them off the ledge call. Call up your investors and talk them off the ledge. Don't let them jump ship now. Yeah, but that's what people do. And in the Business 123 Introduction to Investments class, we actually look at the mutual fund inflows and the outflows, and we see that the inflows tend to peak just as the market peaks, and the outflows peak just as the market bottoms. People, it's the emotions. Reevaluate your mutual funds periodically. Make changes judiciously and sparingly. You like that word? Judiciously? I like that word. And as you approach retirement, you're going to migrate from stock funds to bond funds. But don't give up on stocks entirely. We're going to see, even in retirement, you still need some growth. We'll see that in our next chapter and illustration. And use dollar cost averaging. $50, $100 a month, whatever you can afford. But for the most part, forget about them. I know, it makes investing boring, but it works. And in the investment world, boring is good. Remember in chapter 12, one of the most boring companies in the world, they sell soap and toilet paper and diapers and shampoo and razor blades. Yeah, Procter & Gamble. So boring is good in the investment world. And it makes it you got a life to live, right? So most of you are not going to be wanting to take I hope you take Business 123, but you're not going to want to choose your own investments, right? You're not going to choose your own stocks, your own bonds. So mutual funds are the investments for the masses. Great. Now, in our next chapter, our next presentation, it is totally lecture only, because they took it out of the book. But it's a very important chapter, in my humble opinion, if only to show you these are things you should stay away from. Because the vast majority of us are not going to become real estate investors. We're going to buy our own home, so in that respect we are a real estate investor, but not going to become a landlord. We're not going to invest in precious metals or jewels or gold or play with derivatives and options or exotic strategies which will lose. You might win, but you might as well go to Vegas. Okay? But do check them out in our next presentation, our next module, our next chapter, and we'll see you in real estate and other investment alternatives. Thank you again, dear students. We thank you so much for sticking out this far. We are so proud of you.